Okay, so now we are on reading 31, Corporate Governance. Now, what you might notice in this reading, and some of you already know this is not a quantitative topic. Depending on your background and your interest, this might be very interesting or very dry. So, I actually think that if all of you are working now, and if you put your working hat on, the sort of material that you cover here is actually quite interesting. So it's easy, and what you will notice is that I'm going to be reading a lot of material, and I thought about this. So you might wonder what value is being added if I'm just reading material to you, and I thought about this too. In the past, I would just tell my students that you read this on your own because it's fairly straightforward. But then the value that I think that comes here is twofold. One is this material is being recorded. So the best use of your time would be you can take the MP4 file, download it on your mobile device, your smartphone or whatever gadget you hang out with, and on your commute to work you can just listen to this. That saves you a lot of time reading. So there are no graphs, no explanations. All you need to do is just hear these 35 points from this reading, and if you just listen to it a couple of times, you save a lot of reading time. So that's one point. The other point is just by listening to it, I also notice that when I tell my students read it, most people don't read it till the very end, by which time there are 500 other things to worry about. So here at least you are forced to, you're a captive audience. Whether you like it or not, you are going to listen to all the corporate governance best practices. So consider it like forced learning, which you have signed up for, so I don't feel any sympathy. Okay, so first of all, let's start now. Introduction. What is corporate governance? A basic definition that you should know. Corporate governance is the system of principles, policies, procedures, responsibilities and accountabilities used by stakeholders to overcome the conflicts of interest inherent in a corporation. And we'll get into more details, but it's essentially a system of policies, procedures, etc. to overcome conflicts of interest. What are the things we'll do in this segment? We'll talk about objectives of corporate governance and the key attributes of a good corporate governance structure. What are the different forms of a business and the conflicts of interest that arise in each one of these forms? The major sources of governance problems, the standards and principles of corporate governance, some environmental, social and governance factors, and finally the impact of corporate governance on the valuation of an entity. Okay, section 2 now, the objectives and guiding principles. First, the major objectives of corporate governance should be: number 1, eliminate or mitigate conflicts of interest, particularly those between managers and shareholders. Okay, so that's the main objective. And the second objective is to ensure that company assets are used efficiently and productively and in the best interest of its investors and other stakeholders. Then the attributes, and these are self-evident, so I'm not giving any further explanation. You just need to learn these 2 bullets under objectives. Then under attributes, delineation of the rights of shareholders and other core stakeholders. So we need to know what the rights of shareholders are, what the rights of managers are, and so on. Clearly defined manager and director governance responsibilities to shareholders. Okay. Identifiable and measurable accountabilities for the performance of the responsibilities. Fairness and equitable treatment in all dealings between managers, directors and shareholders. And finally, complete transparency and accuracy in disclosures regarding operations, performance, risk and financial position. So these are the main attributes, and the rest of this lecture will be an elaboration of these. Section 3 then is what are the different forms of business. Many of you have probably seen this. There are 3 major forms: sole proprietorship, a partnership and a corporation, and this is simply table 1 from your curriculum. Okay, we'll just go through each one very quickly. In a sole proprietorship, there's a single owner, so I run a company, I'm the owner of that company. Any legal issues, very few. It's very easy to form a sole proprietorship. Legal distinction between owner and who runs the business, no, because the guy who owns it runs it. Liability is unlimited. What does this mean? This means that if I do some damage and somebody sues me, they can take my business and then they can also get into my personal assets. So the liability is very large. Ability to raise capital, very limited for obvious reasons. Transferability of ownership. If I want to sell half my company, that's very hard. So I might sell the entire company if people want to buy it. So there is a bit of a transferability issue. And owner expertise in business, obviously it's essential. You can't run the business until you have the relevant expertise. Partnership is simply an enhanced version of sole owner, where you have multiple owners. Again, relatively easy to form. There is legal distinction between owners and business, not really. Liability, again, it's very high but shared amongst the owners. Limited ability to raise capital, ownership not transferable, and again expertise is essential. And finally, corporation, which is the one we are most interested in. So ownership, unlimited ownership, you can have millions of shareholders. Legal requirements, it takes a lot of legal paperwork, legal work to set up a corporation. There is a separation between owners and the people who run the business. So owners are the shareholders, the managers run the business. Liability is limited. So if the business does something that's wrong and is sued, the most it can lose is its assets. People can't go after the assets of the owners. Okay, ability to raise capital is very high. Easily transferable ownership, shares trade very easily on the stock market, and it's not necessary for the owner to have expertise in the business. So this looks very good, but what are the issues? The issues that most of corporate governance is based on is the agency problem, which is also called the principal agent problem, where the incentives of the managers are inherently at odds with the incentive of the owners or shareholders. Okay. Now, segment 4, what are the specific sources of conflict and what are the agency relationships? Now, you probably know this already, but just to set a context in your picture. So if you have this company and you have managers who are running this company, and you have millions of shareholders who have a share in this company, the three major entities are the managers, the shareholders, and obviously if we have 1 million shareholders, it's hard for them to interact with the managers. So we have this entity in the middle which is called the directors or the board of directors. So the board of directors represent whom? They are supposed to represent the shareholders, and a lot of what we study in corporate governance is around these directors in terms of are they really representing the shareholders or not. If you feel that the directors are getting too close to managers, that's a problem. Okay, so you will keep seeing this concept of independent directors. Independent means independent of shareholders or independent of managers. It means independent of managers. And very often in large companies, a problem is that the directors and managers are not independent. Okay, so if there are three entities, managers, directors and shareholders, the two kinds of conflicts that we'll talk about are between managers and directors and between managers and shareholders. So first let's talk about the manager-shareholder conflict. What are the inherent conflicts? The agent, who's the agent in this context? The agent is the managers. They might make the firm much larger than it needs to be without economic justification. You might have heard of large mergers where the economic justification was not there. But why do managers still go after large mergers to become a bigger company and so on? Bigger company means higher scale, higher pay scale, higher prestige and so on. So these happen all the time. Okay, what will a little shareholder do out of this? It's hard, but there is a conflict. Managers will go for bigger, because that means more salary, even if it's at the expense of shareholder value. Excessive compensation, perquisites, etc., so fancy offices, club membership does not add value to the shareholder, but it benefits the manager. Taking too much risk. So if a manager's compensation is based on a certain fixed amount, and then based on the company's stock price going through the roof, there is an incentive for the manager to take excessive risk, because if the risk pays off, he makes a ton of money. If the risk does not pay off, then he still makes his salary. So there might be an incentive for the manager to take more risk than he should be. Okay. Another scenario is where the manager could be taking some risk, but is so risk averse because he feels that if by any chance the risk doesn't pay off, then he gets fired. So the other possibility also exists where projects that he should be taking on, he doesn't, because he just doesn't want to rock the boat. Okay, so these are just 4 common examples of conflicts between manager and shareholder. And most of you probably won't read this unless it is forced on you, but I think examples in the curriculum are, I think it will take you a few minutes to read. I will read some of these with you, and I just think they are very interesting. The first one was Enron. That's a little longer, so that you read on your own. That's one of the best examples, and the reason I find this fascinating is in the 90s I did my MBA, and many of these cases here that we are learning about after the fact, about all the bad things they did, when I studied, they were cases of how good companies are run. So I just find it very amusing to come and, like, Enron was the star, imagine. So the problems were found out in the late 90s. So in the mid 90s, it was in an industry that is old and dying, and here is a company that has a stock price going through the roof, earnings going through the roof. So every MBA school was doing case studies on Enron. Okay, so I was in that cycle that was studying how Enron is so good. And similarly, companies like Tyco, so that you see over here. Now let's look at Tyco. This is hilarious. And so Tyco provides another well-known example. The earlier one, number 1, was Enron. So of a corporate governance failure, the CEO of Tyco used corporate funds to buy home decorating items, including a $17,000 traveling toilet box. Okay. What's a traveling toilet box? It's a traveling toilet, I don't know. A $445 pin cushion, $15,000 umbrella stand, and to top this all off, he borrowed money from the company's employee loan program to buy $270 million worth of yachts, art, jewelry, vacation estates. Then, in his capacity as CEO, he forgave all the loan. Okay. All told, the CEO may have looted the firm and thereby its shareholders of over 600 million. And when a case was filed against him, do you know what his defense was? He did not deny any of this. His defense was that it was not illegal, which might be a perfectly valid defense, but this shows clear example of huge corporate governance issues where the manager can effectively get away with taking so much money from the shareholder. So I just thought this example was good. And then a couple of other interesting ones. So this was another company that was one of my case studies in business school. An Italian firm, Parmalat, was one of the world's largest dairy food suppliers. So this is a Italian company, and you'd be amazed at the number of similarities between Italians and Pakistanis. Okay, the founder and top executive of Parmalat were accused of fictitiously reporting the existence of a 4.9 billion bank account so that the company's enormous liabilities would appear less daunting. So they showed higher assets so that compared to the assets, then even high liabilities would look small. Okay, by hiding the true financial condition of the firm, the executives were able to continue borrowing. Obviously, if a lender saw that this company already has very high debt in its structure, it would have a problem. But when it saw a 4.9, banks are willing to lend to you when you have a lot of money. Okay, so they tried to show that we have a lot of money. The fraud perpetrated by Parmalat's largest shareholders and executives hurt Parmalat's creditors as well. Actually, did I miss this? By hiding the true financial condition of the firm, the executives were able to continue borrowing. The fraud perpetrated by Parmalat's largest shareholders and executives hurt Parmalat's creditors as well as the shareholders. Why? Because obviously they could not generate profit for the shareholders, so the stock price fell. And then if the company assets lose so much value that equity is down to zero, once equity is down to zero, then can you go into negative equity? Yeah, because you get to a point then where the liabilities are more than the assets. And when liabilities are more than assets, then even the bondholders start losing out. So that's what happened. Parmalat eventually defaulted on a 185 million bond payment in 2003. So here they are showing 4.9 billion in their bank and they cannot pay off a 195 million bond. The reason I highlighted this after the previous example, in the previous example it's almost hilarious but maybe not illegal. So corporate governance failures can both be what you saw earlier, where you have high perquisites, like if an executive in Pakistan spends a very high amount of money getting membership to all the largest clubs or the best clubs, that would be a corporate governance failure, but it might not be illegal. Here with Parmalat, you have corporate governance failures where illegal things are also happening. And then this is also interesting. During the 90s, Adelphia, the fifth largest provider of the cable entertainment in the US, and the company's founders embarked on a aggressive, so this is the founders of the company, aggressive acquisition campaign to increase the size of the company. During this time, the size of Adelphia's debt more than tripled from 3.5 billion to 12.6 billion, so huge numbers. However, the founders were also arranged a 2.3 billion personal loan which Adelphia guaranteed. So just to help you understand the structure, and this happens a lot in the US, so you have a bunch of founders that start a firm and initially they might have say 50% of the company. As these guys start expanding and try to bring in shareholders, bondholders, let's say they go public. When they go public, then the founders might only be left with 20% of the company and 80% might be owned by other shareholders. But typically the founders might still be controlling the company in terms of trying to raise more money or whatever action. So the founders know a whole lot more about what's going on. So these are the founders slash managers. So they still happen to have 20% of the stake in the company, but 80% is owned by outside shareholders who don't know what's going on in the company. So this is the scenario here. So the founders also arranged a 2.3 billion personal loan which Adelphia guaranteed, but this arrangement was not fully disclosed to other stakeholders. So not fully disclosed essentially means that not disclosed. Okay, so the rest of the guys did not know that these founders have taken a $2.3 billion loan guaranteed by Adelphia. What does that mean? That if they do not, if the founders do not pay, then the company will pay. So this is also called a contingent liability of sorts, which might not show up on the balance sheet, but it's off balance sheet, and if bad times happen, then it's a loan that the company has to pay. Okay, so this is another huge corporate governance issue. In addition, it is alleged that fictitious transactions were recorded to boost accounting profits. So they might have some sister concerns or other related parties. With those related parties, they are doing these transactions to show high profits. These actions by Adelphia's owners, these are the original founders, were harmful to all of Adelphia's non-founder stakeholders, so all these guys, including investors and creditors. The company collapsed in bankruptcy in 2002. So what this is highlighting is if you have weak corporate governance, then the chances of collapse go up, and very often the largest or most common reason for companies completely collapsing are related to corporate governance issues, and that's why this is so critical. If you found this clip interesting and informative, please visit my website www.arifirfanullah.com. Here you will find a tremendous amount of useful material. Right here in the 2011 CFA video lecture series, you will find the entire level 1 curriculum for free, and most of the material here is still relevant. So this is worth looking at. The 2012 video lecture series covers both Level 1 and Level 2. These lectures are available for a fee. And finally, down here, financial management at IBA. Here you will find my lectures at IBA for a course on financial management. Plus you'll find lots of useful spreadsheets that can help you with financial modeling. So again, please visit www.arifirfanullah.com. Thank you.